All right, so let's talk about insurable risks. So in order for a risk to be insurable, we need a few things to be true. So first, let's talk about the law of large numbers and homogeneous exposures. Basically, what needs to happen is for this to work from an insurance perspective, you need to have a situation where basically there are a large number of people that could use the insurance. And as a result, the law of large numbers will basically apply. So for instance, if I look at just one house, okay, I look at one house, there's a 100% chance that it either burns down or doesn't, okay? So if I'm an insurance company, that's problematic to insure because either it's going to burn down or it's not, okay? Now, technically, I recognize that you can have some damage in between there, all right? But the basic idea is either it catches fire or it doesn't, all right? On the other hand, if I look at, say, 10,000 homes, okay, if I look at 10,000 homes, then basically what will happen at that point is that the overall probability of a home burning down that applies kind of more generally across, say, the country is more likely to be pretty close to true across those 10,000 homes. So for a risk to be insurable, that law of large numbers needs to hold, which basically means as I get a larger and larger and larger group of insurance people or insurance policies in this pool, that basically that probability becomes more and more and more predictable. And if the probability becomes more and more predictable, the insurance company doesn't know what house is going to burn down. But if they have 10,000 insurance policies, they can probably predict reasonably accurately how many are going to burn down. And the more predictable it is, the more they can correctly set how much they need to charge in premiums to basically pay for this. And so then they can write policies and charge proper premiums and so forth. Now that also means that we need these exposures to be pretty homogeneous. And what that means is it starts getting more complicated if, for instance, some of those 10,000 homes are at much more risk of burning down than others. So if they are in some cases, much more at risk of burning down than others, it gets tricky because then it doesn't quite fully apply to say just because I have a larger pool that I know exactly what the probability is, unless I factored in the notion that some of them may have more risks than others. So the more homogeneous the exposures are, so the more uniform the exposures are, and the larger the pool that we have, the more predictable the outcomes are, and the more an insurance company can go in and say, all right, in this group, here's what's going to happen. Also, the risk does have to be accidental. So they'll require that the risk and the loss be accidental. So for instance, if you buy an homeowner's insurance policy and you start your own house on fire, they're not paying for that, okay? Because that was not accidental. You intended to burn your house down. So the losses have to be due to that probability assessment. In other words, it has to be due to chance and not intentionality. The same thing actually goes with liability coverage. If somebody is in your home and they slip on your stairs and fall down the stairs and break a leg, and basically they say it was because they tried to grab onto the handrail and it ripped out of the wall, and they're saying it was negligence because you should have made sure the handrail was secure. Well, in that case, this was accident. This is all one giant accident, right? So there's a probability associated with an accident like this happening. Again, if I've got thousands and thousands of policies as an insurance company, I can come up with a pretty good estimate of how many of those kind of events we're going to have across the group, and I can do an insurance policy for it. Now, if you push somebody down the stairs and they break a leg, that's a whole different story, and this is illegal, right? We can't be trying to harm somebody, and that's also something that the insurance company is not going to pay for that. The losses do need to be measurable and determinable. So in other words, we need to measure how much of the loss we have, determine exactly how much that is. It needs to be measurable and determinable. So I need to measure the risk, determine the amount of loss, and otherwise I can't do an insurance policy on it. I apologize if you hear some kiddos in the background having a little bit of a rough time right now. So Also, there are some limits due to if the effect that it could have on an insurer. So for something to be an insurable risk, there are some challenges. For instance, if I deal with like an earthquake. So typically with like a house burning down, it's like one random house burns down, maybe out of thousands, and you can do an insurance policy on that. Now, if I have an earthquake could hit a whole section of a state that could damage thousands of houses all at once. And that could be something that could basically bankrupt an insurer. So there are often some limits due to the effect on an insurer that may affect whether or not the risk is insurable. So something like an earthquake, oftentimes earthquake insurance has to be subsidized for companies to offer it. Same thing with flood insurance, because floods tend to not just hit one house, they tend to hit a whole area. And so from that standpoint, flood insurance can be a real problem as well. Or if you're thinking about the effects of like nuclear war or something crazy, the insurance company is just like, they're not going to cover that. They can't cover that because you could have a situation where like an entire city is obliterated all at once. And so there's no way that that works from the insurance model. So there are some limits, certain types of risks that just aren't going to be insurable. Also, for a risk to be insurable, it has to be doable at sort of a reasonable cost that people can actually afford to pay for it. And so if you have an insurance that's just going to cost too much because there's too high of a probability of losses, then it may not be really an insurable risk. And that kind of goes back to things like flood risks. So people who live along coastal areas in known hurricane paths, typically that can be difficult to get, say, flood or hurricane insurance to cover that. And the reason for that is if they charged what it really would cost due to the probabilities and the damage that those kind of events could inflict on houses, then nobody would be able to afford it. So you get into a situation of either there has to be some kind of subsidy for that, or it just isn't an insurable risk. All right, so hopefully that gives you some context about insurable risks, and I'll pick up with some additional topics in the next video. Have a great day.